Hey guys, what's up? Alec back with the daily stock market, and we had a killer week last week, up almost 5%, $1,900. And in the last month, we've been up 14%. And from our lows, we were down, remember, 13% at one point. But from low to high, in just 1 month time, we were up 35%. The stock market has been rallying, and the stocks that we've been investing in specifically have been going up and away. Now, in this video, I'm going to go over 5 stocks that I'm going to be buying in the month of June. I was thinking about making this for the close friends list only because it's going to be a banger video, but I'm going to give away this video free to all, so I hope you guys do enjoy it. You take some notes, and we all make money from this video specifically. Just to do a quick update, in the last month, we're up 14%, but in the last 3 months, we're up 27%. So it kind of just keeps getting better and better. So from the week to the month, we have a good percentage gain. And then from the month to the 3 month, we have a good percentage, 27%. And then the 3 months to the year, 65%. So DM me if you specifically want access to my trades and being able to see what I'm buying and selling every single day. Okay, so let's get right into the video. So the first one that I'm going to be buying in the month of June is going to be ticker symbol BABA, Alibaba, right? This is one that's down 1.7% on the week. So on the killer week that we just had, it didn't make any upward movements. So remember, from its down point, it was a 206. So it looks like it's starting to rebound a little bit from its low points. In the last 3 months, it's down 4.3%. Also, because it's at a 52-week low, this is a great price that I like to buy into Alibaba. And I think they're a company to not just hold for a couple months, 3 to 6 months, but this is also a company that you want to take with you for the next 2 to 3 to 5 years with you as well. It's an international company, so you'd be diversifying your portfolio. So here you'll actually see Alibaba is one of the largest corporations in the world and focusing on retail, cloud, and payment services. Now, the company is clearly facing risk due to the tension between Jack Ma and the Chinese government, but I consider these risks to be only temporary. Alibaba is growing with high pace, has a very stable balance sheet, and outperforming many of its peers. In my opinion, the stock is severely undervalued, okay? Now, this article got cut off a little bit. It says, can Alibaba hit $500 if you got time? And the answer is yes. Alibaba is a battleground stock where some see a lot of opportunity while others may see risk. I believe that there's both risk and opportunity, but would see the prior outweigh the latter. In the long run, BABA has a chance of delivering strong gains for those that buy at the current valuation, which is quite low. You'll go on to further read, shares are now basically where they were 1 year ago, as the gains during summer 2020 have now been erased. When Ant Financial IPO's plans were stopped, the flat share price performance over the last year is somewhat surprising, though, as Alibaba continued to generate strong results in that time frame. During the last quarter, for example, Alibaba showcased a revenue growth rate of 64%. Okay, so that's why I'm really bullish on them too, is because they beat numbers and they had a revenue growth rate of 64%, which is huge, while revenue growth during the previous quarter was also very strong at about 50%. This is not the only positive in Alibaba's earning release, however. The company also managed to grow its users. The company also managed to grow its user count by 32 million during the most recent quarter alone, which equates to an annualization growth rate of around 20%. This bodes well for the future quarters, as most users of Alibaba's platform should translate in higher revenue growths. On top of that, the strong user growth shows that there is still growing demand for the shopping service that Alibaba platform offers. The market is not saturated at all. Alibaba also managed to grow its EBITDA by 25% year over year. Wow, which is an attractive growth pace as well. Okay, so now if we pull up their income statement and balance sheet on BABA, what you'll actually see is they've been growing net incomes. And in 2020, they had the 73% growth in net income. And if we go to total revenue, look at that. They've been consistently growing revenue double digits every single year. An absolute revenue growth monster from 46% to 73% to 40% growth to 27% to 52% growth in 2020 on total revenue, which is absolute monster and beast mode. After that, we go over to its balance sheets and we see that the total assets is significantly more than the total liabilities, which is a great thing to look at. If you want me to do a deeper dive in the income statement and balance sheets on BABA, let me know, and I'll be happy to go over all of these. Just from looking at it very briefly, it looks very good. The short-term investments are up 435% year over year, which is absolutely amazing. Total current assets are up 50% year over year. Long-term investments are up 34% year over year, and a bunch of other good stuff, but this is an important one. Total assets is up 39% year over year. And if we just look at the total liabilities real quick, total liabilities up 51% year over year, which is not too much of a good thing. And their long-term debt is up 21% year over year, but it's good because they have short-term investments and other stuff good too. So overall, I give their income statement an A+. Their total revenues monster. Their net income isn't as good as I would like it to be, so I'd probably just give it an A, not an A+, but their total revenue is monster. So overall, I am excited to buy Alibaba in June and load up a little bit more on my position. I only have $617 at an average cost of $230 and a total return of negative 5%. So I want to average my cost lower. Anything under $230 is a buy in my opinion, especially if you're holding for long term, 1 to 2 years. We can definitely see this one at $250 to $300 per share again. And I think it can make some fast movements up also once people catch on what's going on with Alibaba and everyone wants a piece of it too. So it could be a good potential swing trade at these levels. Okay, so the next stock that I'm going to be buying in June is going to be TDOC, and that's Teledoc Healthcare. And they are one, look at that, that is down on the year. So they're basically at a 52-week low right now. And in the last 3 months, they're still down 21%, dropping very significantly in late April into the month of May. But if we zoom out, you can actually see the sharpest drop happen from mid-February to mid-March. They dropped around 31% in the span of 2 weeks. Okay, so now in my opinion, this can be a swing trade up to about $180 to $200 is very realistic. I think $250 is also very realistic, but it just depends on how long you want to hold it and your goals. Now, I think in the long term, this one can get back up to $250 because this is an industry that is booming. Now, a lot of people might say that didn't do much between 2016 and 2020, but look at that. It's a 300% gain in the span of 3 to 4 years. That's about 100% a year on Teledoc. And if you don't know what they do, they engage in the provision of telehealthcare services using technology platforms via mobile devices, internet, video, and cell phones. Its portfolio services and covers medical specialties from non-urgent. So basically, if you don't want to go into the doctor and you don't want to walk in with all the sick people, and this is why it really took off, is because the whole pandemic, when the shutdown happened, not everyone wanted to go into the doctor because they were afraid of getting sick just from going into the doctor. So what Teledoc, and they're the leader in the space, keep in mind, they're the biggest in the space. You can just video conference, you can Zoom your doctor, you can even do it over the phone. So this is a disruptive stock that's still pretty early on. They're not too profitable yet, so they're at a pretty good price point. Teledoc users base and revenue have grown rapidly and are expected to continue to grow following the pandemic. Teledoc is one of the most mature competitors in the telehealth, and they're actually combining with a chronic care management, and it could give it a unique competitive advantage in bidding for future business contracts. The company's robust platform efficiency matches patients with provides to avoid costs, visits, and assists employers and payers with analytics to analyze cost benefits. What you'll see is there's a difference between damaged stocks and damaged companies. Teledoc's business remains healthy, which is good news. Investors should see a breakout of Teledoc's whole person care system primary 360 over the next few years. The cheap valuation and massive addressable market makes Teledoc a compelling opportunity at its current valuation. The stock market is judgmental in the short term, but pretty efficient weighing machine in the long run. Investors can sometimes generate compelling returns by finding a mismatch between the company's stock performance and its business performance. In other words, look for broken stocks where the underlying business remains healthy, which is TDOC, a moneymaker. Virtual healthcare companies, TDOC, has the look of a broken stock at the moment. The border market is up 14% over the past 6 months, while Teledoc has sunk 28%. This large disparity would suggest that something is wrong with TDOC's business. However, I don't believe this is to be the case. The company continues to grow, and its whole person healthcare system, Primary 360, is just getting started. With the stock trading near lows, near 52-week lows, TDOC is a compelling opportunity at its current levels. The stock is broken, but the business is just fine. While the stock's share price performance is disappointing for investors, Teledoc's actual business continues to grow. Revenue is rapidly growing quarter after quarter. Bears have pointed to languishing paid member growth and how Livingo's business, Chronic Care, is driving the narrative operating results. And you can kind of read some of these: revenue growth, 181 million, 241 million, 289 million. We'll also check that in a second. Also, however, I find this to be an extremely short-sighted view on things. This is for a couple reasons. Yes, TDOC saw a rapid uptick in growth users due to COVID. However, TDOC is retaining its members base as we begin to move past the pandemic. The assumption that virtual healthcare is a fad is misguiding. Not only telehealth usage been climbing prior to COVID, but it's also saves the healthcare system, ensures the money. Economic saving for insurance company will be the primary driver of the adoption going forward. That's really important. I'll say it again. Economic saving for insurance companies will be the primary driver in adoption going forward of the virtual, Teledoc healthcare systems. Meanwhile, there are multiple buttons being pressed to drive Teledoc operating metrics. In the meantime, Teledoc is in the early stages of rolling out its long-term product, Primary 360. This is a virtual primary care, personalization, healthcare at the patient's level. Okay? So that's very important to realize that this is also a long-term stock. So not only do I think a good swing trade 3 to 6 months to 12 months will be beneficial, but this will also be a good one to hold for 2, 3, even 5 years, or something that you should consider even putting into like a Roth IRA or a long-term account. Now, you can see that they are not a profitable company yet, which is a little bit of a red flag, but that is actually typical with bigger growth companies. So remember, this one is still a little bit more risky. None of these are guarantees, especially TDOC and BABA. These are not guarantees, but these are growth stocks with a little bit more risk that can offer you a little bit more growth potential that I personally believe in. Now, total revenue. And the good thing about these two stocks, by the way, also, is if they don't perform in 3 to 6, 12 months, which personally I think they will, if you hold for long term, 2, 3 years, they will definitely be performing. I think they can do 100% growth potential over the next 2 to 3 years, these two stocks. So with that being said, you can actually see their total revenue is an absolute machine, an absolute revenue beast. Look at that. From 2016, they grew 89%, 2017, 79%, 2018, 32%, 2019, and 97% in 2020. These are unreal numbers. Normal companies are not growing by almost triple digits every single year, right? 89%, 97%, almost a triple digit year. They're up to 1 billion. They went from 500 million to 1 billion in revenue year over year. And I bet if we go a little bit deeper into their income statement, so they're even doing better now. Their total revenue over year is 150% gain. And just in Q1 of 2021, you can actually see that they've done 400 million in one quarter. So they're on track for 2 billion in 2021 if they keep everything up. So it'll be another 100% revenue growth gain from 2020 to 2021. So the revenue growth is absolutely exploding, and I don't see it slowing down. Another great thing. Wow, look at their balance sheet. That's unreal. They have 10% to assets to liabilities, right? So, I mean, liabilities to assets. They only have, if we go into their balance sheet, we can actually see exactly. Let's just kind of go over everything. Cash and cash equivalents is up 41% year over year. Short-term investments is down a little bit. Account receivables is up 152%, which is really nice. Remember, that's like their month, like a subscription-based receivables kind of thing, people signing up. So their revenue from that is going up. But what we really want to look at is their total assets. Wow. Look at that, up 1,000%. That's unreal. Total assets year over year up 1,000%. That's a very safety net for the company. So the risk, if you want to look at the risk of a company, look at their balance sheet. And if they have a lot more assets than they do liabilities, you know that they can pay off any debts they have very easy, because their cash and cash equivalents, they have $720 million in cash, right? And if we scroll down and look at their liabilities, they only have 1.7 billion in liabilities, and they have, again, on assets, 17 billion. Wow, so that's almost 10 times as much assets to liabilities. That's unreal. One of probably the best balance sheets that I've actually seen. They've grown their assets 1,000%, catapulting their balance sheets to one of the best I've seen, because their assets are 10 times the liabilities. Typically, I think 3 to 5 times is out of this world, and I love companies that have 3 to 5 times as much assets to liabilities. TDOC has 10 times. So in my opinion, they're a pretty safe bet for the next 2 to 3 years long-term hold. So guys, just to recap, I'm buying anything under $150 for long-term. I think that's a great position to buy into. And if it gets as low as $130, then I'll be loading the boat up at that point. I want to hold for long-term. I think 3 to 6 months will be a great swing trade potential. 20 to 30% gain within 3 to 6 months, I think, is very realistic. But I'm going for a 2 to 3 year hold on this one, because I think they can easily gain 100% or more, especially as they keep expanding. Now, guys, that video turned out to be a lot longer than what was expected. We only went over 2 different stocks. So comment below, please, if you like the longer videos where I do a deep dive and go over everything, in my opinion, revenue growth, net income, balance sheets, income statements, articles on companies. Let me know if you like those videos every once in a while. We won't do them too often, because I know you guys like when I talk about a lot of different stocks, like 5 to 10 different stocks in the video, or kind of give a market update. But let me know how you like these deep dive videos, and if you want me to do them more frequently. Also, since we talked only about 2 different stocks today, I'll also do a video on Monday, tomorrow, with 2 to 3 more stocks for the month of June. Since we didn't get to do all 5 stocks today, this video might have been an hour long if we ended up doing 5 different stocks. So I hope you guys don't mind. I will put out the rest of the stocks tomorrow. I hope this video does benefit you with the 2 stocks we talked about. And share it with a friend if you found value in it. If you want to join my program, if your profile doesn't really look like this in the past month, or the past 3 months, 27%, past year, 65%. Let me know. DM me on Instagram, The Daily Stock Market, same as YouTube, same as Instagram. You can find me on either platform, but DM me on Instagram if you do want to get a hold of me and want to join my program and get access to my trades. I have a private group available where I post all my trades. All right, guys, I'll see you in the next video. Remember, don't time the market, buy the market. Peace.